7:21 Monday morning. I'm joined by Sean Binkley from you are a mortgage and wealth advisor. And Sean, we're talking about really the cornerstone of your business in many cases, credit, and the 3 C's of credit.
Yeah, so the 3 C's of credit are something that we use in the industry a lot on the lending side of things, which really tells a lender whether someone should be granted money or not. So we'll get to the 3 C's in a second, but a lot of people will often ask me, well, you know, I can afford I've been paying rent of $1,200 a month for the last 10 years. How come they won't give me a $250,000 mortgage?
Yeah,
why not?
You figure you're good for it.
Exactly. But there's a lot of other decisions that come into that. And, you know, unfortunately, you can be a really nice person and be nice to puppies, right? But there's a lot of other things that are taken into account when it comes to lending money.
Okay. So what makes up the decision for a lender to decide if they are going to hand out the money or not?
Yeah, so the 3 C's, and we've got them on a board here, are credit, capacity, and collateral. Very simply, and we'll get into it in a second, but those are the 3 decisions. So on the next board rather, credit, we're talking about whether someone has repaid their debts in the past. Okay. It's your credit score. Are there any judgments or collections against you? We talked about this a few weeks back. Have you had slow payments? What type of experience do you have with credit? Are you new to credit or not? And overutilization, are you up to the max on your credit card? So that's one of the first C's, or the first C rather, that a lender looks at is, are you paying your bills right now or have you in the past?
Yeah.
The next C on the following board is capacity. And capacity really is, can you afford to do this according to a lender? Now, some people are different than others. Some may not spend their disposable income on, you know, eating out 5 days a week, or, you know, things like childcare takes up a lot of disposable income as well. But so that's really your debt service ratio, and maybe in following weeks we can get into exactly how to calculate that. But quite simply, it's how much of your income is going to debt. Type of your income. If you're working part-time casual position and that hasn't been for a number of years, then a lender's going to look at that and wonder whether that's going to be income that continues.
I see. So they look at it as a bit unstable, I suppose. If it's not that steady income that's a guaranteed